1974 was not just a crisis, it was a warning and the beginning of something new. It showed us the global finance can break when the rules don't keep up, and it taught us lessons that still shape every payment system, every regulation, and every safeguard we depend on today. What we learned back then still protects us. History only matters if we learn from it. Let's start with the most direct lesson of 1974 settlement risk. Herstatt showed that the world something terrifying simple. If one side of a global transaction pays but the other side doesn't, the loss doesn't stay local. It ripples across the world. Banks in New York sent Deutschmarks to Germany. Germany shut Herstatt down, and New York never received the dollars back. That one break, that one missing leg, shook the entire currency market. So after 1974, the regulators redesigned settlement systems to eliminate this risk entirely. The new rule became both sides settle at the same time or the transaction doesn't happen at all. This gave birth to systems like RTGS, that is real time gross settlement, and later CLS, continuous linked settlement. These systems made sure that money never disappears into a time zone gap again. Never send money into a black hole. By the mid 1970s, banks were no longer local institutions. A single bank would have branches in London, New York, Zurich, Hong Kong, all moving billions across borders. But here was the problem. Money became global, but supervision stayed national. Each country watched only its own corner. No one had fully visibility of the whole bank. So when one office took risks in Switzerland, another office in London could collapse, and no regulator had the complete picture. The failures of 1974 showed how dangerous this fragmentation was. That's why the world created something new, a group of global regulators who could cooperate, share information, and build rules that applied across countries. This became the Basel Committee, and their work led to the first global rule books, Basel I, Basel II, and eventually Basel III, the standards that shape banking today. So, global finance needs global rules. Banking often looks like a world of numbers, screens, and transactions. But underneath all of that is something far more human, that is trust. Trust that money will arrive when it is supposed to. Trust that rules will hold when they are needed. Trust that the bank you deposit into today will still be standing tomorrow. 1974 nearly broke that trust, and when trust breaks, the entire financial system begins to shake. That is why every reform after 1974, from settlement systems to global supervision, has one silent goal: to protect trust and to protect time. A bank is a belief backed by systems. The lessons of 1974 were not just historical footnotes, they built the systems we depend on every single day. Every time you make a payment on UPI, every time a bank uses SWIFT, every time money moves through RTGS or CLS, you are protected by rules created because of the failures of 1974. And even today, We still feel the echoes. In 2008, when banks around the world collapsed under hidden risks, in 2023, when Silicon Valley Bank fell because withdrawals outran time. Every crisis reminds us of one truth. Whenever trust cracks, the world remembers 1974. Because the safeguards we have today exist only because someone somewhere once got hurt. Safeguard exist because someone once got hurt. This was more than a banking story. It was a turning point in how the world chose to work together. The failures of 1974 taught us something essential, that no system survives alone. So we built systems that protect money, we built rules that protect people, and we built trust, that one thing finance cannot live without. Trust that payments will arrive, trust that banks will stay standing, trust that when something goes wrong, the world knows how to respond. And we learned that trust in finance is not automatic, it is earned every single day. Finance grows when trust grows. Well, thank you for joining me on this journey.